Good morning, everybody. Today we are going to focus on different topics, different global macro topics. The first one will be some comments on the US dollar. Then we will switch to bond markets with US and German 10-year bond yields. And we will end with a focus on the S&P 500 and European markets with the DAX 30 index. So if we start with some comments on the dollar index. The dollar index, as highlighted a few days ago in my daily report, completed this week a daily perfected setup 9 sell. So you can see the signal here, which was a potential sell signal, trading sell signal for the US dollar at the start of this week. The signal was amazingly good, which makes me think that the technical bounce we saw in late June, early July was probably just a technical, short-lived rally within a trend which is starting to deteriorate on the US dollar. So the first warning on the about this trend deterioration was the breakdown below the 200-day moving average, and the fact that the dollar index moved back above its 200-day moving average last week. Does not mean that we will necessarily move back to new highs. So the bearish reaction on this setup 9 sell for me indicates that traders are becoming more confident to sell the US dollar on strength. So it's an indication that probably the big picture of the US dollar is becoming a bit toppish, with a further downside ahead in the near term, with the US dollar possibly breaking below its 200-day moving average again. Or at least, I mean, the most bullish case right now would be to see further sideways trading below 98. If we now switch to the euro dollar, so this is more or less the reverse of the dollar index, we can see that, I mean, the big picture is still bearish on the euro dollar, but we started to see a significant technical bounce in June. Even though this technical bounce was not confirmed in the short term, I think the fact that the euro dollar held above 112 this week shows that possibly we are forming a rounding bottom formation, which suggests that selling pressure is starting to ease significantly on the euro dollar, with the euro dollar possibly forming a bottom ahead of an upside breakout. So if we look at the resistance right now, so I told you the support zone was around 112, 111, and the resistance zone is becoming 114, 114.50. So I think we are likely to see a slow turnaround of the euro dollar and possibly ahead of an upside breakout above the 114, 114.50 area. The best exchange rate to illustrate this toppish process of the US dollar is the cable. So if we look at the British pound against the US dollar, the British pound is one of the weakest currency in Europe against the US dollar. But even on the British pound, we saw a successful test of January lows. So you probably remember this flash crash. And the lows of January were retested and successfully tested. Which means that even the British pound is probably becoming, we didn't have a breakdown on the British pound against US dollar. So this is rather encouraging, so a nice trading buy starting on the British pound as well. Now if we switch to US 10-year bond yields, start of a technical bounce, so we start to see a revival of US bond yields after an amazing decline, a move back above 2% this week. The first resistance, as you can see very clearly here, is around 220 to 25, this Fibonacci retracement. My advice would be for someone who was playing this mean reversal process, I would rather advise to book some profit on shorts around 220 yields. if we break above this zone, then it would mean that it could be something more important than what the technical bonds we saw previously, for example, in March and April on this declining 50-day moving average. So if we see a breakout, I think there will be a risk of additional strength to the 240 area, so here. So, but right now, I think it's time to be a bit more cautious for someone who is shorting T-notes with a potential resistance around 220 in the short term. If we look at the German 10-year bond yields, a very similar outlook. So an amazing decline in May, June. And over the last couple of days, we saw V-shaped reversal, which looks like a mean reversal so far in a downtrend. So it's too early to call for the end of the downtrend on German bond yields. But what we are seeing right now is obviously a technical reaction within the downtrend. You can see that the first resistance zone around minus 0.20 is now closed, is now almost reached. So same comment on US bonds. For someone who is shorting German bonds, I would book at least a part of the profits around minus 0.20 on yields. If we see further rise, let's say in coming weeks, maybe months, then the next cluster of resistances would be around 0. But I would favor, in the short term at least, possibly start of a pullback after the reversal of the last few days. If we now switch to equity markets, so we start with the S&P 500, we can see that the technical bonds of US 10-year bond yields is not really something frightening for US equity investors right now. We can see that the S&P is still hitting new highs, is still trading above the resistance line I previously mentioned. So this one was broken 2 weeks ago, and this week we even saw a successful test of this line, which is now becoming support. So at this stage, I'm not telling you the market will rise forever, but at this stage we continue to see a clear uptrend on the S&P 500, and with a critical support zone around 2950, holding so far. So as long as the index is still holding above this level, which is not far, I mean it's less than 2%, I see no reason to be very negative from a technical point of view on this market. In Europe, the outlook is a bit different because, like on the S&P 500, for example, this is the chart of DAX, we saw a significant upside breakout in early July with a nice bullish gap. But this gap, as you can see, was filled this week, suggesting that the upside breakout we saw in early July was not sustained. So it means that the technical outlook in the short term, I mean the big picture is still bullish from a technical perspective, but the short-term outlook is deteriorating a bit. For example, yesterday we saw a daily MACD sell signal. So the technical situation is a bit more tricky in the short term in Europe than in the US. So that's something obviously to keep an eye on, and this suggests that it's possible that the European markets will suffer more from a weakening US dollar than US ones, which is, I mean, a weakening US dollar is very good for US equities, but not so good for European equities. So there is a possibility of starting, or at least invalidating the upside breakout we made in early July on European markets, and possibly start of a sideways trading pattern on European markets. Have a great trading day and a nice weekend. Bye.